Disclaimer.
Good morning. While most traders are still drinking coffee, the silver miners market just got something we've been waiting for years. Today, January 16th, as U.S. stock markets prepare to open, overnight trading in Asia and reports from Australian mining companies confirmed that the breakout that no one saw coming has already begun. Miner stocks are no longer following the paper price of silver. They've started their own vertical game. It's happening right now. In this video, I'll show you the charts that Wall Street has been trying to ignore and explain why today's New York Open could challenge short sellers. If you thought silver was just a metal, you may have missed the main capital move in miner stocks. Let's take a look at why today is your last chance to understand this breakout. Picture this. You watch silver blast through every resistance level, shattering records day after day, climbing past $91 an ounce to reach heights nobody thought possible. You're checking your portfolio, expecting the mining companies that pull this metal from the ground to be absolutely soaring alongside it. But when you open your brokerage app, something feels wrong. The numbers don't match what you're seeing in the silver charts. Here's what should grab our attention right now. Silver has delivered a staggering gain of roughly 180% from its lows, pushing past every analyst's wildest predictions to establish new all-time highs above $93 earlier this week. Meanwhile, SIL, the leading silver miners ETF that holds companies like First Majestic, Pan American Silver, and Hecla Mining, has managed gains of around 160% during the same period. Think about that for a moment. We're witnessing a significant valuation gap between the metal and the companies that extract it, with silver trading at $91 today while the miners lag behind. This disconnect has never existed in previous bull markets to this degree. When silver ran from $15 to nearly $50 in 2011, the miners didn't just keep pace. They crushed the metal's returns by multiples of 3 to 5 times. That's the historic norm, the pattern that's played out in every precious metals rally for the past 50 years. Operating leverage should mean mining stocks amplify the metal's gains, not trail behind, like some anchor's been attached to their share prices. So what's different this time? What force is powerful enough to suppress an entire sector while the underlying commodity reaches unprecedented heights? The answer involves a geopolitical chess move that reshaped global supply chains overnight, combined with a high-stakes financial battle playing out in real time as you're watching this. Let me take you back to January 1st, just 15 days ago. While Americans were celebrating New Year's Day, China implemented sweeping export restrictions on silver, tungsten, and antimony that sent shockwaves through industrial supply chains worldwide. According to reports from CNBC and the Ministry of Commerce, these restrictions effectively tightened control over 60 to 70% of global refined silver supply in a single day, as China now requires special government licenses for all silver exports. You might be wondering what makes this so significant. These metals are critical to modern industry, and China's decision to weaponize their mineral dominance didn't happen in a vacuum. The ripple effects cascaded through silver supply chains almost immediately, tightening physical availability in ways we haven't seen since the pandemic shortages of 2020. Except this time, there's no pandemic causing temporary disruptions. This is a deliberate strategic decision by the world's second largest silver producer to control critical mineral flows. The evidence of this supply shock is showing up in real-time pricing data across Asian markets. According to multiple bullion market reports, buyers in India and China are now offering substantial premiums above the spot price just to secure physical silver, with Shanghai Gold Exchange and India Bullion and Jewelers Association reporting tight physical conditions. When you see premiums that extreme, you're not witnessing normal market dynamics. You're seeing panic buying driven by genuine scarcity. Think about what significant premiums mean when silver is trading at $91. Sophisticated institutional buyers who understand physical markets better than almost anyone are scrambling to get their hands on the actual metal. These aren't retail investors paying inflated prices at coin shops. These are refineries, industrial manufacturers, and bullion banks trying to fulfill delivery obligations in a market where physical metal has suddenly become scarce. Now here's where our story takes a dramatic turn, and why today specifically matters more than you might realize. Every third Friday of the month, the options market goes through something called OPEX, Options Expiration Day. It's when thousands of contracts betting on silver's price either pay off spectacularly or expire worthless, depending on where the metal closes at market settlement. Today is January 16th, the third Friday, and according to market data, there's substantial open interest stacked at key strike prices around current levels. We're talking about positions worth potentially billions of dollars that will either print money or vanish into thin air based on where silver settles today. The banks and institutions that sold contracts at lower strikes, betting silver would never reach these levels, are now facing difficult decisions as the metal trades well above many of those strike prices. Let me put this in perspective with a scenario you can visualize. Imagine you sold insurance policies promising to pay out if someone's house exceeded a certain value, and you priced those policies assuming real estate would never surge. Then suddenly, a supply shortage drives home prices up nearly 180% in less than a year. Now, all those insurance policies you sold are coming due, and you're legally obligated to pay the difference. That's essentially the position some market participants find themselves in today. The open interest at these strike prices represents contracts that give holders the right to buy silver at predetermined levels. With silver currently trading above $91, many contracts are already in the money, meaning they have intrinsic value. If silver holds these levels through today's settlement, the institutions who wrote these contracts will need to deliver physical silver or pay cash settlements to contract holders. Given the physical shortage we just discussed, acquiring that much silver quickly becomes a complex undertaking. But wait, there's another layer to this situation that makes it even more compelling. When options are deep in the money heading into expiration, market makers who sold those contracts face what's called gamma exposure. They need to hedge their positions by buying the underlying asset, which in this case means either buying physical silver or buying shares of silver mining companies. This hedging activity can create a feedback loop. As prices rise, market makers must buy more to remain hedged, which can push prices higher, forcing them to buy even more. You've probably heard the term short squeeze before, where traders betting against a stock get forced to cover their positions by buying shares, driving the price up explosively. What we're potentially looking at today is related pressure driven by options market dynamics. The 2021 GameStop saga familiarized millions of people with how these squeezes work, but most investors don't realize similar dynamics can apply to commodities and commodity stocks. Now consider the timing of China's export restrictions hitting just 15 days before this critical options expiration. Whether intentional or coincidental, the effect is undeniable. Physical silver has become significantly harder to source right when market participants may need it most to settle in the money contracts. The premiums in Asian markets aren't just numbers on a screen. They're warning signals that the usual supply channels have been disrupted at a challenging moment for anyone holding short positions. Here's what makes this situation particularly fascinating from a trading perspective. The silver mining stocks, despite silver's moonshot rally, have been held down by something that defies normal market logic. When a commodity rises 180% and the companies mining it only rise 160%, you're watching unusual price action, likely influenced by sustained short selling from institutional traders, betting the rally would collapse. According to short interest data and reports from financial analysis firms, several silver mining stocks have seen their short interest reach elevated levels despite the ongoing bull market in the metal itself. SILJ, the junior miners ETF, shows particularly notable short positioning despite delivering strong returns year to date. Someone with significant capital has been betting against these companies even as they post strong earnings and silver prices reach all-time highs. Think about the psychology here for a moment. These aren't amateur traders making bad bets. These are sophisticated institutional desks with risk management teams and advanced modeling systems. Yet some have maintained bearish positions, even as silver climbed from $70 to $80 to $90 and beyond. Either they see something the rest of the market doesn't, or they've found themselves in difficult positions they can't easily exit without triggering the very moves they are trying to prevent. The historical precedent for what happens next comes from 2011, the last time silver experienced a major bull run. Back then, silver climbed from around $17 to nearly $50 between January and April. The mining stocks lagged for the first 2 to 3 months of that rally, frustrating investors who expected immediate amplification. Then suddenly, in March and April of 2011, the miners exploded. Companies like First Majestic gained over 400% in just 8 weeks. Pan American Silver rose 300%, and even large producers like Silver Wheaton, now Wheaton Precious Metals, doubled in a matter of weeks. But here's what's different this time, and why today might mark an important inflection point. In 2011, the miners lagged for 2 to 3 months before catching up. This time, we're 4 months into silver's rally, and the valuation gap has persisted longer than historical norms would suggest. The coiled spring has been compressed for an extended period. When that pressure releases, whether today during OPEX or in the coming sessions, the velocity of the move could be significant based on historical patterns. We're standing at a unique moment where multiple forces are converging. A physical supply squeeze created by China, is strategic restrictions starting January 1st, substantial options, open interest at strike prices that could challenge short positions, elevated short interest in mining stocks despite a powerful bull market in the underlying metal, and historical patterns suggesting a catch-up rally may be overdue. Today, this options expiration is not just another routine market event. It is one of several factors that could influence how this situation resolves. According to analysis from major investment banks including Citigroup, silver could reach $100 per ounce by March 2026, driven by the structural supply deficit that's now in its fifth consecutive year. The Silver Institute reports that global demand of approximately 1.24 billion ounces exceeded total supply of around 1.01 billion ounces in 2025, creating a deficit of over 230 million ounces. That's the equivalent of Mexico's entire annual production. And it's happening while China, which controls the majority of refined silver supply, has just implemented export restrictions. The question isn't whether the miners will eventually close the valuation gap with silver. History and operating leverage math suggests that outcome is likely over time. The real question is when that catch-up begins to accelerate and what catalysts, like today's options expiration, continued physical tightness, or upcoming quarterly earnings, might trigger institutional repositioning. Understanding what is happening beneath the surface of these price charts could mean the difference between capturing a significant opportunity or watching it unfold from the sidelines. As silver trades at $91 today with mining stocks still showing historical valuation discounts, the market is sending a clear signal. Something's got to give. Either silver needs to come down or the miners need to catch up. Given the supply fundamentals, the export restrictions, and the structural deficit, smart money is watching closely to see which way this resolves. And with COMEX registered inventories at multi-year lows while physical demand remains robust, the path of least resistance may favor the miners finally closing that gap. Now, let's dig into the hard evidence that proves we're not dealing with speculation or market sentiment. We are watching a fundamental supply crisis unfold in real time with mathematical precision. The data coming from exchange vaults, mining company balance sheets, and global trade flows tells a story that's impossible to ignore if you know where to look. Start with the vault numbers because they reveal just how severe this physical shortage has become. COMEX registered silver inventories, that's the metal actually available for delivery against futures contracts, have collapsed by approximately 70% since 2020, according to CME Group's own warehouse reports. We're not talking about a modest drawdown here. We're talking about the disappearance of hundreds of millions of ounces from the world's primary price discovery mechanism for silver. But it gets more dramatic when you zoom out globally. The London Bullion Market Association vaults, which handle the majority of institutional silver trading outside North America, have seen roughly 40% of their holdings vanish over the same period. Meanwhile, Shanghai Gold Exchange inventories hit 10-year lows in late 2025, right before China implemented those export restrictions we discussed earlier. Think about what that means. The three major silver trading hubs on Earth are simultaneously running on fumes. Here's where the math becomes impossible to escape. According to the Silver Institute's World Silver Survey, global silver demand in 2025 reached approximately 1.24 billion ounces, while total supply, including both mined production and recycled metal, delivered only about 1.01 billion ounces. That's a deficit of 230 million ounces in a single year, and this marks the fifth consecutive year the market has been in structural deficit. 5 years straight of consuming more silver than we're producing, and the gap keeps widening. You might be wondering where all that silver's going if inventories are draining and we're running deficits year after year. The answer lies in irreversible industrial consumption that doesn't care what the price does. Solar panel manufacturers alone consumed record amounts of silver in 2025, as the global push toward renewable energy accelerated. Every solar panel requires silver paste for its photovoltaic cells, and there's no viable substitute that maintains the same efficiency. Electric vehicle production is eating through silver for battery management systems and power electronics. The artificial intelligence boom is driving semiconductor demand to unprecedented levels, and semiconductors need silver for their conductive properties. This isn't like jewelry demand that flexes with price. When silver was $15 an ounce, solar manufacturers used it, and now that it's $91 an ounce, they're still using it because their panels don't work without it. That's what economists call inelastic demand, and it's precisely why the supply deficit isn't resolving itself through normal market mechanisms. Industry can't just decide to use less silver when margins get squeezed by higher metal prices. Now let's talk about what this means for the mining companies actually pulling silver out of the ground, because this is where the disconnect becomes truly absurd. Take a company like First Majestic Silver or Pan American Silver, two of the largest primary silver producers in the world. They're all in sustaining costs, which include everything from drilling to processing to corporate overhead, typically run somewhere between $30 and $35 per ounce, according to their most recent quarterly reports. Do that math with me for a second. If it costs you $32 to produce an ounce of silver and you're selling it for $91, what's your profit margin? You're making $59 of profit on every ounce, which translates to profit margins above 65%. These aren't tech companies with unlimited scaling potential. These are mining operations with fixed production capacity posting margins that would make software companies jealous. Yet when you look at how the market values these companies, something bizarre is happening. According to data from major financial terminals, silver mining stocks are trading at price-to-earnings ratios below 25 times earnings in many cases. Let me put that in perspective for you. During previous precious metals bull markets, miners routinely traded at valuations of 50 to 80 times earnings when metal prices were surging. We're talking about companies generating record cash flow, paying down debt, and sitting on assets that just became significantly more valuable. Yet the market is pricing them as if silver is still at $40 an ounce. This valuation anomaly becomes even more striking when you consider that every dollar silver rises from current levels translates into pure profit for these companies. Their costs are essentially fixed in the near term. They've already developed their mines, installed their processing equipment, and locked in many of their input costs. Operating leverage in mining means that a 10% increase in the commodity price can translate into a 30, 40, or even 50% increase in profitability. Yet the stocks aren't reflecting this reality. Here's where the story diverges from 2011 in a crucial way that makes the current setup even more explosive. During that bull market, silver climbed aggressively, and the miners lagged for about 2 to 3 months before institutional money finally capitulated and started buying the mining stocks. When that shift happened, it happened violently. We saw mining companies deliver 300 to 500% gains in just 8 to 10 weeks, as the undervaluation became too obvious to ignore. This time around, we're now 4 months into silver's parabolic move. And not only have the miners still not caught up, but the gap has actually widened in recent weeks. Why? Because instead of covering their short positions and reversing course, many institutional traders appear to have doubled down on their bets against mining stocks. SILJ, the Amplified Junior Silver Miners ETF, shows elevated short interest levels despite having delivered gains of nearly 200% year to date, according to recent short interest data. Think about the contrarian psychology at play here. Someone is so convinced that silver's rally will collapse and miners will crash that they're willing to short stocks that have already doubled or tripled. In a market where the underlying commodity is hitting all-time highs and physical supply is demonstrably tight. This is not prudent risk management. This is either supreme confidence in a pending reversal or desperate position defense from traders who got caught on the wrong side and are hoping for a bailout. The physical market is sending signals that directly contradict those short positions. We mentioned the premiums in Asian markets earlier, but let's get more specific about what's actually happening on the ground. Reports from the Shanghai Gold Exchange and Indian bullion dealers indicate that physical silver is trading at significant premiums to the paper futures prices in New York. When physical metal commands a premium over futures, that's called backwardation, and it's the market screaming that immediate delivery is more valuable than future promises. Backwardation is extremely rare in commodity markets under normal conditions because it violates the fundamental relationship between spot and future prices. It only happens when there is genuine scarcity, when people who actually need the physical metal right now are willing to pay extra to get it immediately rather than wait for future delivery. We saw similar dynamics in the oil market during extreme supply disruptions, and we're seeing it now in silver as China's export restrictions bite into available supply. The vault data supports this scarcity narrative with undeniable clarity. Recent reports from independent analysts tracking COMEX deliveries show unusual patterns emerging. Large numbers of contracts standing for physical delivery during months that historically see minimal delivery activity. In January 2026, according to CME data analyzed by precious metals researchers, we've already seen over 8 million ounces delivered in early settlement, with substantial additional open interest still outstanding. This suggests that major players are using the futures market as a physical delivery mechanism rather than as a hedging tool, which is precisely what you'd expect when spot physical metal is hard to source. Here's what makes this particularly relevant for mining stocks. As physical tightness increases and delivery pressure builds, the market eventually has to reprice risk. If you're a bank or institution that sold futures contracts promising to deliver silver, and suddenly you're facing the prospect of actually having to source and deliver physical metal in a market where China just cut off 70% of refined supply, you've got a serious problem. Your options are limited. You can try to buy physical metal at whatever price necessary, you can roll your positions forward and pray the situation improves, or you can hedge by buying mining stocks that give you exposure to future production. That third option is where the catch-up trade becomes inevitable. Mining companies own silver in the ground, reserves and resources that will be produced over the coming years at costs far below current spot prices. As physical supply tightness persists, those assets become exponentially more valuable. Yet the stocks haven't repriced to reflect that value because short sellers have been actively suppressing them. The moment those shorts begin to cover, whether by choice or by force, you get a cascade effect, where buying begets more buying. The earnings calendar provides another catalyst that many investors aren't focusing on yet. Most silver miners will report their fourth quarter 2025 results in late February and early March 2026. Those reports will show the full financial impact of silver's surge above $80 and $90. Record revenues, exceptional cash flow, debt reduction, and potentially significant guidance increases. When companies like Wheaton Precious Metals, Pan American Silver, and Kerr Mining report quarterly profits that exceed entire prior years, institutional investors who've been sitting on the sidelines will have no choice but to reevaluate their assumptions. According to analysts at major investment banks, consensus estimates for mining company earnings haven't fully incorporated sustained silver prices above $80. Many analyst models were built assuming silver would trade in the $50 to $60 range for 2026, meaning actual results could significantly exceed expectations. When companies beat earnings estimates by 30, 40, or 50%, that tends to get attention from momentum traders and algorithmic funds that key off fundamental surprise metrics. The short interest data suggests we're approaching an inflection point where the risk-reward calculation for maintaining bearish positions becomes untenable. Every day that silver holds above $90, mining companies are generating cash flow that makes their current valuations look increasingly absurd. Every week that passes without a significant correction in metal prices makes it harder for shorts to justify their positions. And every month that China's export restrictions remain in place makes the physical shortage more entrenched and harder to resolve through normal market channels. We're not dealing with a temporary supply disruption that can be solved by bringing mothballed mines back online or increasing recycling. The deficit is structural, driven by irreversible industrial consumption growth in sectors that are expanding, not contracting. Solar capacity additions are accelerating globally, electric vehicle penetration is increasing, semiconductor demand is being driven by AI infrastructure build-out. These are multi-year trends that consume silver and do not give it back. The question you need to ask yourself is whether the current valuation of silver mining stocks makes sense in this environment. Are companies generating 65% profit margins on record production really worth only 20 times earnings when their costs are fixed and metal prices are at all-time highs? Does it make sense that junior miners with low-cost operations and significant reserves are still trading as if silver is at $50? The market is telling you no, which is why smart money is positioning ahead of what looks like an inevitable valuation reset. Now, let's get mathematical about this, because numbers don't lie, and the operating leverage formula in mining tells you everything you need to know about where these stocks should be trading. This isn't speculation or hopeful thinking. This is basic arithmetic that any mining analyst can verify, and it's the reason institutional money will eventually have no choice but to reprice these companies. Here's how operating leverage works in precious metals mining, and why it's so powerful. Let's use a simplified but realistic example based on typical industry costs. Imagine a silver miner with all-in sustaining costs of $30 per ounce. That's their total cost to find, extract, process, and sell each ounce of silver. When silver trades at $35, they're making $5 per ounce in profit, which represents a 14% profit margin. Not terrible, but not exciting either. Now watch what happens when silver climbs to $91, while their costs remain essentially fixed at $35 after slight inflation adjustments. Suddenly, they're making $56 per ounce in profit, which translates to a 61% profit margin. That's not a 14% increase, that is a 435% increase in profitability from the same physical operations, the same workers, the same equipment. This is the magic of operating leverage in mining, where modest increases in commodity prices create explosive growth in bottom-line profits. But here's where it gets even more interesting for stock valuations. When a company's profitability increases by 435%, the stock price shouldn't just go up by 435%, it should potentially go up by multiples of that, because the market also reprices the valuation multiple. During normal times, a mature mining company might trade at 15 to 20 times earnings. During bull markets in the underlying commodity, especially when supply is constrained and prices are hitting records, those same companies can trade at 50 to 80 times earnings as investors' price in sustained high prices and expanding margins. Do the math with me on what this means for current prices. If a SIL is trading around $96 today with miners earning record profits, and those profits justify a re-rating from current multiples to bull market multiples, you're looking at potential moves of 3 to 5 times from current levels. That would put SIL in a range of $240 to $480. Which sounds insane until you remember that this is exactly what happened in 2011 when similar dynamics played out. Let's ground this in more conservative assumptions to avoid getting carried away with best-case scenarios. Even if we assume mining stocks only re-rate to the midpoint of historical bull market valuations, let's call it 40 times earnings instead of the peak of 80 times, and even if we assume silver moderates to $85 instead of continuing to $95 or $100, The math still points to miners having at least 150 to 200% upside from current levels just to reach fair value relative to the metal price. That's the key insight that bears on these stocks seem to be missing. They're not overvalued at current prices, even after doubling or tripling. They're still undervalued relative to both the commodity they mine and the historical relationship between metal prices and mining stock valuations. The catch-up trade isn't about speculation on further silver gains. It's about mining stocks simply repricing to reflect the reality that's already happened in the metal itself. Now, let's address the elephant in the room, today's options expiration, and what it might mean for near-term price action. As we discussed earlier, January 16th marks the monthly options expiration for silver contracts, with substantial open interest clustered around key strike prices near current market levels. The mechanics of how this resolves could create volatile price action in both silver and mining stocks over the next several trading sessions. If silver holds above $90 through today's settlement, market makers and institutions with short exposure at lower strikes face the prospect of either delivering physical metal or paying cash settlements on in-the-money contracts. Given the physical tightness we've documented, this creates a challenging situation where hedging activity could amplify price moves in either direction. Historical precedents from 2011 show that when similar setups occurred during that bull market, mining stocks could move 10 to 20% in just a few days as positioning shifted rapidly. However, we need to be clear-eyed about the risks here. Options expiration can also create temporary price weakness if large holders choose to take profits or if dealers successfully defend key strikes through aggressive selling. The point is not to predict exactly how today resolves. The point is to recognize that we are at an inflection point where accumulated tensions in the market could release in dramatic fashion, regardless of the specific catalyst. What matters more than any single day's trading is the bigger picture timeline and how this situation likely evolves over the next several months. If silver maintains support above $85 to $88 through the first quarter of 2026, mining companies will report their fourth quarter 2025 earnings in February and March, showing the full impact of record metal prices on their financial results. Those earnings reports become the moment when the valuation disconnect becomes undeniable even to skeptical institutional investors. According to typical reporting schedules, we should see major miners like Wheaton Precious Metals, Pan American Silver, First Majestic, and Core Mining release results between mid-February and mid-March. When those reports hit and show quarterly cash flow that rivals or exceeds entire prior years. When debt reduction is announced and guidance is raised, the narrative around these stocks will shift decisively. Momentum investors and algorithmic funds that key off earnings surprises will have no choice but to buy, regardless of their prior views on the sector. That gives us a reasonable timeline to think about, roughly 6 to 10 weeks from today for the catch-up trade to begin accelerating if fundamentals remain intact. If silver holds current levels and miners report blowout earnings, fair value for the sector would put stocks at roughly 2.5 to 3 times current prices by late March or early April 2026. That's not a prediction. That's a mathematical assessment of where valuations should be based on historical precedents and current profitability levels. Let's talk about risk, because any honest analysis has to address what could go wrong with this thesis. The primary risk is obviously a collapse in silver prices. If silver were to crash back below $75 for sustained periods, much of the operating leverage we discussed would evaporate, profit margins would compress, and mining stocks would likely give back significant gains. That's the nature of leveraged plays. They work brilliantly on the upside, but can be devastating on the downside. However, assessing that risk requires looking at what would actually cause such a collapse in the current environment. China's export restrictions are not going away in the next few months. They're policy decisions tied to strategic resource nationalism. The structural supply deficit isn't resolving itself. It takes 8 to 12 years to bring new mines into production, and there aren't significant projects in development that could meaningfully impact supply before 2030. Industrial demand from solar, electric vehicles, and semiconductors continues growing regardless of price because these industries need silver to function. And what you're balancing then is roughly 200% upside potential if the catch-up trade plays out as historical patterns suggest, against perhaps 30 to 40% downside if silver crashes and miners give back recent gains. That's an asymmetric risk-reward setup that favors being positioned on the long side, especially if you believe the fundamental supply story supports sustained high silver prices rather than a speculative bubble that will pop. For those trying to think through position sizing and risk management, consider that we're not at the beginning of this move. Silver has already doubled and miners have already had significant runs. That means being thoughtful about entry points and not chasing parabolic moves in individual names. The safer approach is broad-based exposure through ETFs like SIL or SILJ that give you diversified access to the sector without single stock risk. and sizing positions appropriately for the volatility that precious metals mining stocks can exhibit. One critical point that often gets overlooked in discussions about mining stocks: these companies are generating real cash flow right now at current prices. This isn't like speculating on early-stage exploration companies with no revenue and years away from production. The major and intermediate producers are profitable, self-funding operations that are paying down debt and could potentially return cash to shareholders through dividends or buybacks if high prices persist. That fundamental distinction matters when assessing risk. You're buying profitable businesses trading at reasonable multiples, not lottery tickets. The political and policy backdrop also deserves consideration, because resource nationalism is becoming a defining theme of the mid-2020s. China's decision to restrict silver exports isn't happening in a vacuum. It's part of a broader pattern where countries that control critical materials are using them as geopolitical leverage. The United States has designated silver as a critical mineral, recognizing its importance to national security and industrial capacity. This policy attention supports the idea that silver maintains strategic value beyond just its price on commodity exchanges. As we look ahead to the rest of January and into February, watch several key indicators that will tell you whether this thesis is playing out as expected. First, monitor COMEX registered inventories. Continued drawdowns would confirm ongoing physical tightness. Second, pay attention to premiums in Asian physical markets. Sustained premiums indicate the shortage isn't easing. Third, watch the short interest data on mining ETFs. If short interest starts declining rapidly, that's your signal that bears are capitulating and covering their positions. The setup we're describing doesn't come around often in markets. You need a perfect storm of factors: a commodity and genuine physical shortage companies with massive operating leverage to that commodity, valuations that don't reflect current fundamentals, and short interest that creates fuel for explosive moves higher when positioning shifts. We saw it in 2011, we saw it in various other commodity cycles, and we're seeing the pieces align again in silver miners in early 2026. Here's the bottom line that every American investor needs to understand about what is happening in silver and mining stocks right now. This is not about getting rich quick or finding the next meme stock. This is about recognizing when fundamental supply and demand imbalances create asymmetric opportunities in real businesses generating real cash flow. The math is straightforward. The evidence is documented in vault inventories and trade flows, and the historical playbook tells you what typically happens when these conditions align. Whether today's options expiration marks the precise moment the catch-up trade accelerates, or whether it takes another few weeks until earnings season, the direction of travel seems increasingly clear. Mining stocks have lagged silver's rally for 4 months, sitting on profit margins above 60% while trading at depressed valuations. That gap will close. The only question is timing and magnitude. Understanding the dynamics we've discussed gives you the framework to position appropriately for what comes next, rather than being caught off guard when institutional money finally decides the undervaluation is too obvious to ignore.